Okay, so class number 2. So we covered all those things. You'll see in tonight's class we're going to do a couple problems. And so what I mean by that is you should have gotten in the email from Anna a Word document that has 2 problems. We're going to do those in class tonight. So when I say let's do some problems, that's what I mean. And you'll see format-wise, we'll just break for 15 minutes, and I want you to work on them as, pairs or groups of 3 or whatever, and then come back and we'll talk about how you did. I think we've covered those other things. So we've covered intuitive. Okay, so class number 1. So hopefully you got the message clearly that we want to talk about our 3 steps, and focusing first on the payable, and then second on deferreds, and letting the provision fall out. Right? I have to believe that that's abundantly clear at this point. So last week we talked about doing our provision in this type of format, where every fact we were presented with, we would essentially think of it as a balanced journal entry, and we would go through the 3-step process of figuring out, what our impact to the payable is. All right, we said, let's first figure out what our debits and credits are here, and then we'll move to step 2, and we'll figure out, well, what do I need to debit or credit in my deferreds, and then what will come out of that will be my provision, which will be step 3. And if I foot these across, right, they always need to balance. And if I think of every fact as some kind of journal entry that I can just build on top of another journal entry and on top of another journal entry, then ultimately, I can explain my ending balance as the aggregation of a lot of different, smaller component parts. And at some point in the class, you'll see we'll go through a real-life tax account roll forward, and it will look like this, and it will take a company's balance from, say, January 1 of 2012, and it will roll it forward to December 31 of 2012, and it will explain all the things that happened during the year. Right? I had income, I had an IRS audit, I made a tax payment. All those things will create line items in the schedule. And when I'm helping a company with a provision, I will always focus on this type of format to say, how did you get each of your big tax accounts from the beginning to the end of the year? How did you do it? What was the activity? How did it balance? Like, this will give you the whole picture. Okay? All right, so we talked last class about how our total provision would be the summation of our current expense, right? That's how much we're going to owe in the current year. And you probably remember in the table for intuitive, the second table in their footnote broke out their expense between current and deferred. That current included not only this first box, but also this non-current box, which we'll talk about in a second. But essentially, you could look at Intuitive's footnote and see, okay, they expect to have a current liability of X because of current year profits, right? Almost as if you can kind of get a vision of what their tax return looks like. The second part of that table would tell us, okay, are they going to owe money in the future, or are they going to save money in the future? Okay. So if they're going to owe money in the future because of these timing differences we talked about in class 1, we're going to accrue that expense now under our matching principle. Right? So we're going to accrue the tax we owe today, accrue the tax we owe tomorrow, and this non-current tax expense, non-current is like a euphemism for FIN 48, or those unrecognized tax benefits that one of you guys asked Tracy about and she didn't want to talk about. So those are the taxes that you might have to pay in the event of an audit, or there's some kind of dispute with tax authorities, and they're categorized generally as non-current because you're not planning to pay them anytime soon, because it's going to take a while to get audited, have the issue spotted, negotiate, whatever, and ultimately make a payment, right? That's going to span a long period of time. So we're trying to accrue all those expenses today through the P&L, right? Capture the whole picture. Okay, so one of the things I tried to make clear in last class was, and at some point, you know, maybe when Don comes to speak about Yahoo, maybe I'll have him show one of his schedules, or I can cleanse one without a company's name on it to give you an example of what a by jurisdiction provision looks like, just to give you a sense of what a real provision looks like. As far as basics go, so we're going to cover this in class 3, measurement of positions, and this whole unrecognized tax benefit thing, that is also going to be class 3. But tonight we will definitely focus on deferred tax provisions. So I don't have a sense for how confusing this concept is in your minds of, as I change my deferred tax balance, how that creates expense or creates provision benefit, but we will focus on that tonight. That whatever your change in deferred taxes are on your balance sheet, the equal and offsetting effect is something that is hitting the P&L in a sense. Okay? So I fully expect that's confusing when I say the words, but when we go through the examples, I want to make sure that you understand how change in deferreds equals deferred provision. Okay, that's kind of key objective for tonight. So in the next group of slides, I listed, a whole bunch of terms that are defined in ASC 740, and these should have been part of your reading assignment ahead of this class. And you will do yourself a great favor to spend the time to make sure you understand what all these terms mean. Okay? So if you're studying for class, and oftentimes people will ask, well, what more can I do? Go back and make sure that you could explain these terms to somebody else who didn't understand them. Right? Use that as like your litmus test. Not that like I see them on a piece of paper and I recognize them, but if I had to explain it to somebody else who doesn't know what I'm talking about, you could explain what each of these means. Okay, so, and I know this is kind of repetitive, but hopefully it helps at least some of you to go through this. So current expense, right? Current expense is the liability on our current return, or it could be a refund. But think of it as, I make $100 today, I think I'm going to owe some amount of tax based on that $100. I don't know how much it is, but whatever it is, that's my current expense. It's what I owe currently. My deferred expense or my deferred tax provision, that's the amount I'm either going to owe or save in the future. Right? And UTBs, okay, again, I said we're going to cover that in class 3, but UTBs, and again, the term UTB is relatively new, and it stands for tax exposure or tax reserve. Okay? So unrecognized tax benefit means a benefit. For example, you took a credit for R&D, right? You save tax by claiming a credit, but you've unrecognized it because you think you're going to lose it, right? You think Amanda's going to come in and bust you, right? And so you say, well, instead of taking that 20 of R&D credit, I'm only going to take 10, and I'll say that other 10 is an unrecognized tax benefit. Okay, that's what that represents. Okay, so then our total tax benefit is, like I said, the sum of current plus deferred. And it also includes that non-current element related to these tax exposures. Okay, so hopefully I'll go kind of slow through the slides so you can read them at the same time, but hopefully all of this is sounding consistent with class 1 and conceptually straightforward based on kind of what we're trying to achieve here. Okay, return to accrual adjustment. So Tracy mentioned this. It's funny, I didn't tell her at all that we were talking about this topic today, and and she raised it in connection with the fact that it's just after filing the corporate tax return. But, I mean, imagine a simple fact pattern, like you're sitting there, so pretend you're Tracy, and you're sitting there on like January 4th of 2012, and you're trying to do your 2011 provision. And somebody says, well, you know, how much is your permanent difference for meals and entertainment? And she just guesses, right? She looks at the trial balance, says, oh, it looks like it's $100,000. I'm putting in $100,000. It's close enough. I know it's not that far off. I don't have to be perfect for my provision. I just have to be close, right? And so then 8 months go by. They're working on their tax return. They realize it's not $100,000. It's $104,000, okay? So when Tracy accrued her provision in 2011, she didn't accrue enough. Right? She's going to pay more tax than she accrued when she did it on January 4th of 2012. So somehow you need to deal with that, right? And if you think of, well, go through the steps, right? Go through our 3 steps. How does that affect a payable? Well, if she underestimated meals and entertainment on the provision, well, she's going to have to credit her payable for some amount to make up the difference, right? Because she's going to owe it. Somehow you got to accrue it. And she's sitting here in September realizing this, but she's still got to book it, right? Because ultimately this payable is going to turn into cash. So then you go to step 2 and say, well, how does that new information, the fact I realized what I said before wasn't right, how does that change my deferreds? And for meals and entertainment, it doesn't. So then step 3 is, well, gosh, I guess that creates more tax expense, right? And so that's the kind of exercise that Tracy and Carol are going through now. They would say, what did I say at the provision, and how did I get it wrong? And to the extent I got it wrong, I better go book journal entries to start fixing what I didn't get right. And that doesn't mean it's the end of the world. I mean, this just happens, right? She said she had like a nanosecond to close her book, so she's not going to get all this stuff right. So every company has return to accrual adjustments. But all you got to think of them as is an incremental journal entry, as if you could magically go back in time and fix what you did. Right? I mean, at least that's the way I think it's easiest to think of this. So Amanda's question was, when do heads roll? Yeah. Well, so that question is a function of materiality, right? And I always answer that question, or sometimes when I'm talking to companies about what they're putting in their provision, I'll say, look, if you're doing this on purpose, it's usually okay. But if you're doing something and you are surprised by the result, ultimately, that might be a problem, right? Because if you're estimating on purpose and you're doing it with all the facts, you know, at your disposal, then that's what a reasonable person would do, right? But if she said, oh, I thought it was $100,000 of meals and entertainment, and then I realized I missed like 4 GL accounts, and it's actually like $1 million. Well, that's not good, right? What's that? Yeah, it becomes a control issue, and it's, you know, that might be material, and that's not good, right? And so every company is different in terms of what materiality is. But I like to phrase it in the context of, you know, if you're doing it intentionally, that tends to kind of work in your favor, as opposed to if you're just kind of wild-ass guessing sort of thing. So there's not a black and white answer to the question, unfortunately. But you know, you can ask the other guest speakers that. Don would have funny stories to tell you about that, because rarely does he get stressed, but at least that's my perspective. But he could tell you about times he did stress, and it usually will be as a result of what you asked about. Okay, so we'll talk more about this topic in class, but that's return to accrual. Okay. DTA and DTL. Okay, I hope by now it's clear what a DTA and DTL is. Okay, and we'll stop talking about them as deferred tax assets and deferred tax liabilities. We'll just straight go to DTA, DTL. That is how they will be known in class going forward. Okay. So DTA, you save money in the future. DTL, you pay tax in the future, right? These are tax-affected amounts. These are not the gross temporary differences you see on a tax return. These should signify to a reader kind of what the tax value we have in a company is because of tax attributes that will save us money, or things that will cause us a future tax liability, right? And I think if you looked, I mean, we didn't spend any time looking at Intuitive's deferred tax asset and liability table, but I think it's fairly uneventful. I don't recall there being anything really, you know, unique or exciting.
Quick question about how the job gets any easier. Like, for instance, if a company's losing money quarter after quarter after quarter, is it the same complexity as it is when they're making money quarter after quarter after quarter? I mean, I know you're going to defer that, but you're not going to necessarily tax payable.
So Grant's question is, I think, does your job get any easier if you lose money quarter after quarter? And one of my clients was a student in class. I feel like I have a client in class every year. And but one year, one of my clients was this pharma company, and they were almost pre-revenue, but just had giant expenses. I mean, they had an enormous NOL, and not atypical of a pharma company. And I would tell the class, I forget the guy's name, it was a long time ago. He, I actually don't even want to tell you his name, but I would say, you know, look at this guy, right? I mean, his blood pressure is like perfect, right? And, you know, he's not stressed about a thing, like nothing can go wrong, you know? Because when you think of like the 3 steps, you know, he has no payable. So step 1 is 0. And no matter what he does, it's going to be 0. Right? He can think really hard, but it's still going to be 0. And then if you think step 2, well, what defers does he have? Well, normally he has a giant NOL, but you're going to put a valuation allowance against it and tell the reader it's probably not worth anything. So that's 0. So if step 1 0 and step 2 0, well then step 3, you know, you could sit there and try to make it foot all day long, but it's going to be 0, right? And so I'd always joke with him, like, this guy, he has got, you know, the perfect, you know, he's going home and not thinking about work, right? Whereas Tracy, I'm sure she's constantly processing, like, what should I be worrying about? What am I missing? That sort of thing. You should ask Elaine that question, actually, because she works a lot and she stresses a lot. Yeah. Okay. Other terms. So UTB liability is just our reserve, you know, shown on the balance sheet as a liability. Effective tax rate. Okay, so after class 1, you should all be very familiar with what the effective tax rate is. No screwing up what effective tax rate means. Okay. Key for you, you know, if you guys want to work in a company or a firm and you want to do provision stuff, effective tax rate, you need to talk in terms of, well, what's your rate? Why is it high? Why is it low? What was it last year? It's always about effective rate. And if somebody says, oh, my rate went higher because I, you know, didn't have as much depreciation expense, you should be like, that makes no sense. You know, you should be able to take concepts and apply them, and what does it mean to the effective tax rate? That shouldn't be how you just think all the time naturally. Okay. And then rate reconciliation. So, you know, you saw the reconciliation that Intuitive did. It's not so important to really know the words behind this. The magic with rate reconciliations is to be able to do it. And one of my largest clients, they would, years ago, they would do their provision and they would never be able to get the rate reconciliation to work. And I would say, I don't know how that's possible, because unless you've done a rate reconciliation, your provision is not done. If you cannot prove that how you did your rate makes sense, you will have problems. So when we go through our exercises in class, I will have you do like mini rate rec exercises so that you start getting comfortable with how to do it. Okay. All right. Well, speaking of that, so in class exercise 1. So you should have gotten the Word document that we sent out, and this is the one that is Armstrong ink. You will see a lot of the examples are based off of professional cyclists. That's my thing. We get extra points if you notice like the esoteric ones as we go through the class. But I'm sure you guys know who Lance Armstrong is. So anyways, I've given you 7 or 8 facts, and what I'd like you to do is just buddy up with a few people around you. I'm not going to structure it. You guys figure it out and work together and come up with the answers to all of the questions. Okay? So I'll probably give you 10 minutes or so. Okay? I'm not going to take a lot of time with this. Okay, so let's get back together and let's go through the problem together. Okay, so the first one I'll give you as a freebie. I'll explain it. Okay? And then after that, no more of that. Okay? You know I know your names, so you will all do the explaining. Okay, so Armstrong, and by the way, like you know, Gama came and asked me what the answer was. I often don't know. I haven't looked at the problem, so we'll kind of figure it out together. And yeah, we went through this last year, but it's been a year. So, so yeah, we'll go through it together. And sometimes, like, I'll trip up. I mean, I know in the classes I have with these guys, there'll be times where I'm like, that's not right, and we'll have to go back and figure it out, which is perfect, right? I mean, that's kind of how doing a provision is. It's never like just always right the first time. Okay. All right, so we had book income of $100,000, and we had, just a second, let me get my ink thing going. Okay, so we had book income of $100,000, and we didn't record any expense yet. We had meals and entertainment of $5, depreciation for tax exceeded book of $10. We had prepaid insurance that increased by $2,000 during the year. So that's a little confusing, right? You got to know what that means from a tax perspective. And so what that means is we get to deduct $2,000 more because we paid it, even though books isn't going to expense it because they're using an accrual method, but we get to deduct on a cash method effectively. They had $8,000 of tax-free income. Our bad debt reserve increased by $7,000, so that's books expensing bad debts and tax saying, well, we'll deduct that later. And our tax rate is 40%. All right. Okay, so what are our perm items? So our perm items, we have two, right? We have meals and entertainment, which is $2,500. We're going to add back half. Right, and then we have our tax-exempt interest income, which is $8,000. Right, and that's a good guy. Okay, so those are our perm items. What are our changes in temporary differences? Okay, so. Our change in deferred, our change in temporary difference. We had depreciation where our tax exceeded books by $10,000. So that is going to create a DTL, right? Okay, so that's going to create a DTL of $10,000. And let's see, prepaid insurance. So prepaid insurance, we're going to deduct $2,000 now instead of later. So that will also create a deferred liability, because in the future there'll be a book expense, but there won't be a tax deduction. And then we have bad debt reserves, right? And in the future we will get a deduction for what books is accruing now. So we have three temporary differences. If you're expecting my handwriting to get significantly better, I don't know what to tell you. It's unlikely to happen. It's bad because I'm actually trying to write slightly neater. And this is still what you get. Okay, so what's our current liability? So our current liability is our $100,000 of book income, right? Plus our perms. Our perms were the $2,500 add back of meals and $8,000 of tax-free income. So that is a net good guy of $5,500, a net reduction in income. And our temporary differences, we will have a tax deduction of 10 for depreciation that exceeds book, a tax deduction of 2 for insurance that it exceeds book, and then 7 for bad debt reserve going the other way. So we have $5,000 of net deductions. Right? So all of that should give you taxable income of $89,500, and at a tax rate of 40%, that should give you a tax of $35,800. Okay. What is our journal entry to record the $35,800? It is credit payable. That is our step 1, 35.8. And we are going to show it as debit current expense, 35.8. Okay, we're going to break our step 1, step 2, and step 3 into kind of separate entries for current and deferred. Okay, and you'll see how this current expense is going to be offset by a deferred expense in a second, partially. Okay, so our current liability, we're going to accrue our step 1 payable of 35.8. So we're kind of through with step 1. Step 2, so question E, what is the journal entry to record the deferred expense? Okay, so our deferred expense should be the change in our deferred taxes, right? That's what we touched on at the beginning of class. So the change in deferred taxes is going to be the aggregation of these guys, right? And we said that net, we were going to build a 5,000 DTL, right? And that's 5,000 in pre-tax terms. So the 10 and the 2 and the 7 you see there, those are all pre-tax numbers. So if you sum that up, that's 5. And in the future, we will owe tax at 40% of the 5. Right? So we will have a net DTL because the sum of our depreciation and insurance exceed bad debts, and we're going to measure this in tax terms, right? Not in pre-tax terms. So we're going to take this 5 times it by 40%, and that will be 2,000. So our entry will be credit DTL 2 and debit deferred expense 2. Okay. So now you can see, let's see if I can get this to work. You can see that our total expense is going to be, remember how we said it's the sum of our current plus our deferred expense. It's the sum of what we're going to pay now plus what we're going to pay in the future. So our total provision is going to be 37.8. Okay? And the way we're going to do it, the way we're going to get there, is by booking that journal entry and that journal entry. Okay? Now, let's see if we can do a simple rate reconciliation. Okay, we're going to try to cram this into this little space here. Okay? So I thought that I was going to have $100,000 of income, and my tax rate is 40%. So I would have expected a provision of 40 grand, not knowing anything more, right? And my provision ended up being 37.8. Okay? So now you got to figure out how to reconcile that. Okay? I know this wasn't one of the questions, so I get it. You don't have the answer. That's fine. Okay? So who wants to give it a shot? How would you reconcile the provision? Uncle Sam, you were good at this last class.
I think I
You would start with the permanent differences. I would also start with the permanent differences. You and I have that in common. Okay. So, name a permanent difference. Meals and entertainment. I know, that's what you were picking on last class, right? Stop eating so much, remember? I remember. I know, hold on. Let's talk about meals and entertainment first. Okay, so what does that do to me? Fine, I got a perm. I know it's meals and entertainment. What do I do with that? How do I factor that into my reconciliation of my tax expense? My $40,000 I expected is actually lower by $37,800. How do I factor in meals and entertainment there? You would increase your tax liability. So you'd come over here and say, look, you had meals and entertainment, and you had to add back $2,500, and that actually cost you, at a 40% rate, $1,000 of tax, right? That's your, like, stop eating so much moment, right? It cost you $1,000, okay? So what would you do next? Tax-exempt interest, right? Okay, so you had $8,000 of tax-exempt interest, which was actually a good guy, right? I mean, that's saving you tax because that's income that's not subject to tax. So at a 40% rate, that's saving you $3,200. Okay. So does our reconciliation reconcile? Yes, right? You've just done your first rate rec. Coolest thing ever, huh? All right, so that's how you do it, right? When like Tracy at Intuitive does her rate rec, she does it like that. Not with that messy handwriting, but you get the idea. Okay? So remember, in the last class we learned permanent differences change your provision, right? So the fact that we had bad debt reserve or depreciation or any of those numbers, right, that was causing this to go up, this payable, let's say, right, or go down. But then the opposite was true on the deferreds. So as you have an increase in DTA for bad debt reserve, right, you have a bigger credit here. But just the same on your deferreds, you're going to have less of a credit here. So Patty was asking, well, I thought temporary items don't affect the expense. And they don't when you collapse your current and deferred expense entries, right? When you add them together, the temporary differences have no effect. And so oftentimes when I talk about provision, I do like step 1, step 2, step 3. I don't break it out into a current entry and a deferred entry. But that's just the way I think. If you were learning tax accounting kind of from ASC 740 or using these materials, this is the way to do it. This is the way people think. And when you break out your footnote and you describe separately your current expense and your deferred expense, this is how you have to get there. Okay, you have to know separately how your current liability was determined and also your change in deferreds. Okay? All right. So if you get that problem, we're on the right track. How are we doing? Timmy can't see the track. Nice. Okay. We good?
Can you actually explain the prepaid insurance one more time?
Can I explain the prepaid insurance? Sure. So say you're a calendar year company and you form yourself on January 1, 2012. Okay? So on December 31, 2012, let's say you pay next year's insurance, and it's a 12-month contract. Okay? So you're sitting there on December 31st, you go, hey, insurance agent, here's my check for $2,000. That covers me for next year. Okay? So for book purposes, they'll say, well, that relates to next year. So we're going to expense it next year. Okay? That's what books will do. Tax will say, you just apply Section 461 principles, and you'll say, okay, do I get to deduct it for tax? So you'll say, is it fixed? Well, yeah, I signed a contract. Is the amount determinable? Yeah, I just cut a check for it, right? And then you'll go into economic performance. And with something like insurance, you'll basically say that economic performance is payment. And so then you'll say, well, I paid it, so I'm all good. And this thing doesn't extend past 12 months, so I don't have an asset that's subject to capitalization. So that's the way prepaid insurance would work. Nothing. I mean, obviously, it doesn't have to do with tax accounting, but that's how the prepaid insurance works.
What in the following year will be paid in higher? So we have to.
Okay, so Sim.
Yes.
Sim's question was, what happens in the next year? Okay, so right now in class, we're only worried about like the first year of our existence. We live in like utopia. Life will get harder for you, and when it does, we'll deal with that question. Okay? As you can see, right, Tracy's not dealing with year one, so she will always have to deal with last year's problems and this year's problems, and it's just a kind of a rolling, fun time. Okay, any other questions about that example? I know I kind of joke, but if you get that, we're in good shape. I need you to figure out perms versus temps, how to book your journal entries in a balanced sort of way, because this thing's got a balance, and then if you can do the rate rec at the end and explain why your rate is high or low, we're in great shape. Okay? Mike, see if I just pause long enough, somebody will talk.
Does the rate rec only deal with permanent items?
Does the rate rec only deal with permanent items? Yes, for the most part. But there will be times where you look at companies, and this is why we read 10Ks. I want you to see stuff in the rate rec, and you'll be like, what is that? That does not look like a perm. That does not look like meals and entertainment. Yeah. Gama?
Jeff, how will we put all this information into the balance sheet approach?
How will we put all this information into the balance sheet approach? I'm not exactly sure what your question is, but I think...
So, all these, how will we put all that in here?
Oh, into the computer, yeah. There's this international partner I work with a lot, and he wears glasses, and when he looks at his computer, he takes them off because he's like nearsighted, and then he'll be like, I always wait for him to hit his head on the screen. So Gama's question was that matrix that we went through in the slides earlier. How do I get this into that? And basically, you would take. I have to say, this is so unnatural for me to use this tablet. So you would take this entry and put it in as a row in that matrix and say, okay, my current liability, boom, I can slip that in. Credit payable, debit expense. Okay? And then I would go down to my deferreds, and I would slip that into a second row and say, that's my deferred provision. Right? Debit, expense, credit, deferreds. And if for whatever reason that wasn't getting you to the right place, you could break those entries down into what's the entry for book income, what's the entry for meals and entertainment, what's the entry for bad debt reserve. Do it at the most granular level you need to do it at, where you're getting balanced entries that roll forward to the ending answer. And you know you're right if you can do the rate reconciliation, because I guarantee you if you can't get the rate rec to work, there's almost always a problem with what you already did. Okay? All right. We will do a lot of problems like that. All right, that is in class exercise 1. So one of the whole software thing I use, it just captures whatever's on my screen, so I should be able to flip between like Word and PowerPoint and all that, and it works smoothly. And so when I record and you guys play it back, you can tell me if you can see it all right. I mean, it should work fine that way. Okay. So remember how last class I talked about the 10 steps to computing a provision. So we have effectively done step 1. We have identified perms and temps. And I know we've cheated a bit and we've covered some of step 2 and some of step 4. But in the sequence of kind of where we are in the materials, we're going to start going through step 2 in detail. Okay? So I will put this like header page in periodically, just so you get a sense of like directionally where we are in the process of getting from the beginning to end. Yeah, I didn't start a new one, but we're at 40 minutes, so we should have like 15 more minutes. We're good. Okay. So computing our current payable or receivable. I suspect that this is what comes most naturally to you guys, because regardless of your years of experience, you tend to understand how to compute taxable income and a tax liability better than you understand the deferred taxes and some of these accounting type things. Okay, so I'm going to kind of click through this quickly because I'd rather focus us on problems. But if you want me to slow you down or slow me down, just say so, because I don't want to blow ahead and make you frustrated if you want to go slower. Okay, so if I was computing taxable income, I would start with pre-tax book income, add perms temps, subtract NOLs, and what we haven't talked a lot about in the class so far is credits. So, gosh, just about every company in the Valley has some kind of credits, and it's almost always R&D credits. So, for those of you who are not familiar with R&D credits, basically the IRS says if you spend money on R&D and you keep doing that and you do it and ever more dollars every year, well, you would like to incentivize that behavior, so we'll give you a credit. And the credit is some big calculation that people make a career out of dealing with, and call it, say, 10% of your qualifying spend you get a credit for, and that credit reduces your tax liability. That's really all it is. Think of it like, like I'm shopping for solar at the moment. So if you buy solar, you get a credit. Credit reduces your tax. Same thing for R&D spend, right, for companies. Same sort of thing. Min?
So R&D for 2012 hasn't passed yet. When you put interim, how do you enact? Where do you put it?
Man, you love to jump ahead, Lady Min. So we'll cover that in like class 7. Yeah. So when Don is here and he's talking about Yahoo, you can say, how did you do your Q3 provision for R&D credits if it wasn't enacted yet? And the chances are it will not be enacted even by the time he gets to class. Yeah, so are we good with credits? Yeah, okay. So again, for the students who don't have a lot of experience, don't be shy in asking, because if you don't understand what a credit is and you get to the problems and we have a credit, you're going to be like, I don't know what to do with that. Okay. Okay, equivalent to preparing a tax return, right? That's our current payable. Okay, so now we have a little problem. So company has taxable income, or pre-tax income rather, of $1 million. Actually, this is after-tax income of $1 million, and this is after federal tax expense of $300,000. So that would mean our pre-tax is $1.3 million. Assume a federal rate of 35 and a state tax rate of 7, and then they give us all these differences. Okay. So let's just talk about whether these are perms or temps. Jesse, depreciation, is that perm or temp? That is temp. Okay. Let's see, Grant, limitation on meals and entertainment, is that perm or temp?
Perm.
That's perm. Okay. Lena, inventory adjustment, is that temp or perm? You're Lena. Oh, don't mess with me.
It's 10.
That is temp, right? So that means, our book and tax basis and inventory are going to be different, which means we have a basis difference and therefore a temporary item. Non-deductible fines and penalties. Chloe, this one should be easy. Oh. Serves me right. She's had enough. No, she told me she was going to leave early. Okay, Caitlin, non-deductible perm, right? It says non-deductible. That's a good head start.
I have a question.
Yep.
Sorry. So the inventory adjustment, if you have to write that inventory, what would you call it?
Sorry.
Like devalue or like devalue inventory?
So Timmy's question is kind of what's going on with the inventory adjustment, basically. So, like 263A, what 263A is some of your G&A expenses that you would expense for book purposes. For tax, you have to capitalize. And you deduct them as cost of goods sold when you sell the inventory for tax instead. So instead of taking immediate G&A expense, you take it the next year when you sell the inventory. That's what that is. But it could be like, a similar thing could be like a scrap or obsolescence reserve. Book says my inventory is junk. Tax doesn't get to deduct it until you actually scrap it. That sort of thing. Okay, Section 199 deduction. Janie, is that perm or temp? That is perm. Accrual of bad debt reserves. Fung, is that perm or temp? That is temp, right? Okay. Bonuses accrued but not paid within 2.5 months. On. We have to work on your volume, huh? Temp. All right. You have the challenge of being far away. Okay. So, I'm going to skip through this slide. In theory, you would go through and figure this out, but we kind of did it together. And the rest of this really just calculates the amounts. So, here is what we already figured out on our own, which is that we would start with $1.3 million, right, which is our pre-tax income. The example is a little confusing because they gave you the after-tax, but you'll always start with pre-tax when you're doing this type of exercise. So we're going to add back meals and entertainment, add back fines and penalties. The 199 deduction is always going to be a good perm. There's no such thing as a bad perm for 199. Depreciation, inventory, bad debts, and bonuses can all go either way, and there's a mix of examples, or a mix of kind of hypotheticals here. So we calculate our taxable income as $1,343,000, and our state tax. Okay, this is a little confusing. This is the first time we've dealt with this topic. We first calculate our state tax as being $94,000. And then we go on to calculating our federal tax, but as you can see, we take our taxable income and then factor in a federal deduction for the state tax that we're going to pay. So our federal taxable income is actually less than our taxable income before the state tax deduction, right? So this is a little confusing because states are going to base taxable income off of the amount before the state deduction. Otherwise it's circular and kind of silly. So, but for federal purposes, you deduct your state taxes. Okay, so that's what that extra step is for. Okay, so we take our taxable income after our state deduction, multiply it by the tax rate, and that is our current provision. Okay, so if you're thinking from an effective tax rate perspective, right? Like I said, hey, I want you to think all the time, how does this change your effective tax rate? What does having a state tax do to your effective tax rate, Shuking? Well, for federal that's true, but what about this guy? What does this 94 do to our effective tax rate? We're going to start by assuming that our tax is at 35%, right? If you're intuitive, your rate rec starts with the assumption that you have a 35% tax. So if you come along and say, I have to pay state taxes, what does that do to your effective tax rate? Right? It makes it go higher. So your tax rate will go higher, right? Because you have to pay state tax incremental to federal, right? It's almost like you found this bad thing that you didn't start with assuming, and that bad thing is state taxes. And I think what you said a second ago was, well, from a federal perspective, there is actually a good guy. Your federal tax goes down by 35% of that state tax, because even though it's a bad thing that you have these state taxes and that's incremental to your 35% federal rate, you do get a deduction that isn't in book income, right? There's no, state tax deduction in that number you're starting with, but suddenly you get a state tax deduction. So that's like a perm, right? It's a good perm. So state taxes, people will always say, when you look at their rate recs, they'll always say like state tax net of federal benefit. And the reason they do that is they say, well, really, my 94 is not my provision effect. My 94 is a 94 bad guy offset by a 35% of 94 good guy. So I'm just going to tell you 65% is my state tax effect. Okay, so people will do that all the time. We good with that?
You did it
When you came back to the 65%.
Yeah.
You wouldn't, what is it?
Okay, so let's say, I'm just going to write on a space that's somewhat empty here. Better yet, I will just try to insert a, how come I cannot insert a slide? Okay, so let's think of journal entries, okay? We seem to be working well with journal entries. So if I have to pay state tax of 94, okay, and I do my step 1, step 2, step 3 thing, and let's just assume that all that stuff was perm that got us to the 94. Forget the fact that there's perms and temps in there. So my step 1 is to credit my tax payable of 94, and I have no deferreds, okay, because I'm going to, let's assume that this is state first of all, okay. I'm going to do my state provision. I'm going to owe 94 tax, say there's no temps, so I would debit expense for 94,000, okay. So then I come along to my federal provision, and I would say, well, the fact I paid state taxes is actually going to allow me to save federal taxes because I get to deduct the state taxes. So if I go through step 1, step 2, step 3, I am going to debit my federal tax payable by, call it 33, right? 35% of 94. I have no deferreds, so I will credit my tax expense 33. Okay. And the sum, if you think of your total expense, it is the sum of 94, which is a debit, and 33, which is a credit. So really, on a net basis, you paid 61 of state tax after the federal benefit. Okay. So when people say state net of fed, they mean that's 61 because they're putting those two things together.
In the rate reconciliation?
In the rate reconciliation, that's right. Okay, so I'm going to pause for a second and stop one file and create another. So just give me a second, and you can noodle on.